If you have ever furnished an apartment, you know this exact feeling. Tightening that final metal bolt on a bookshelf or a coffee table. The Swedish retailer built its brand on the promise of democratic design, creating simple, affordable, everyday home furnishing solutions that anyone can pick up and piece together. The sheer volume of those affordable purchases adds up quickly. In fiscal year 2025 alone, the company generated 26.31 billion euros in total revenue. But look past the maze-like showrooms and the cheap cafeteria hot dogs, and you find one of the most guarded, privately held corporate fortunes in the global economy. Tracing exactly where those 26 billion euros go is surprisingly difficult. The straightforward Swedish furniture maker disappears into a dense financial labyrinth the moment you look at its accounting. The truth is, there is no single IKEA company. The operation is splintered into a web of holding entities, isolated intellectual property owners, and a sprawling charitable trust. To understand how this retail empire actually makes its money, we have to look past the Flatpack furniture and examine an impenetrable financial fortress, one designed to minimize tax liabilities and block hostile corporate takeovers. The foundation of this wealth dates back to 1943. A 17-year-old named Ingvar Kamprad started out selling pens and wallets in his hometown in Sweden, eventually transitioning into furniture by 1948. Moving large wooden tables and fully assembled chairs quickly became a severe logistical bottleneck. Kamprad faced exorbitant delivery costs and high rates of merchandise getting damaged in transit. In 1953, the company adopted the Flatpack method. By forcing customers to assemble the final product, they removed the dead air from a shipping process, drastically slashed delivery overhead, and allowed for direct delivery and extensive inventory turnover. Physically compressing the product standardized the entire operation. That single logistical decision became the economic engine that funded decades of explosive global expansion into Norway, Japan, Canada, and beyond. Today, when a customer buys a sofa at a retail warehouse, that money goes directly to the entity operating the physical space. The majority of these stores are run by a parent group called IKEA Holding. But IKEA Holding has a pivotal structural catch. It operates the physical retail footprint, but legally it does not actually own the brand name attached to its storefronts. The corporate architecture isolates the assets. The iconic blue and yellow logo, the proprietary designs, and all other intellectual property are locked away in a separate and legally distinct company. Because they are separate, the physical stores must pay a substantial franchise fee back to the IP owner just for the right to use the name. A franchise fee is simply a licensing charge paid by a business operator to the owner of a brand. In fiscal year 2025, that internal charge amounted to 1.32 billion euros. By separating the physical stores from the brand itself, the parent entities can shift profits across corporate borders, systematically lowering their overall taxable income. If you follow the ownership of the physical stores further up the chain, IKEA Holding reports directly to its ultimate parent entity, the Netherlands-based Stichting IKEA Foundation. This parent organization is legally classified as a charitable foundation, placing it among the wealthiest philanthropic entities on Earth. Operating as a charitable trust carries heavy strategic advantages. A charity has no traditional shareholders, which means no outside investor or rival corporation can ever buy up enough stock to force a hostile takeover. The architects of this system placed a hyper-efficient, profit-driven retail network directly underneath a philanthropic umbrella. That arrangement secures permanent, tax-advantaged independence for the entire operation. Legal structures can block rival executives, but they cannot stop macroeconomic forces. The retail empire is currently facing significant external pressure. This descending bar chart tracks recent net income. In fiscal year 2024, the company cleared 2.2 billion euros. By fiscal year 2025, that number dropped 32%, down to exactly 1.5 billion euros. That profit compression comes directly from surges in daily operating costs and the cost of goods sold, the direct expenses tied to manufacturing and procuring their global inventory. Maintaining high-overhead suburban mega warehouses is generating diminishing returns in an environment where basic supply chains have become significantly more expensive. To adapt, the parent organization is tapping into its shielded wealth to aggressively pivot its real estate footprint and internal supply pipelines. They are abandoning the megastore requirement. Instead, the company is opening 20 new, much smaller urban outlets across Europe and North America, stocking only everyday essentials rather than heavy bedroom sets. They are also optimizing how those goods arrive. The Inca Group recently bought an AI-powered logistics software company to calculate delivery routes, ensuring every shipment moves with minimal overhead. Decades ago, their engineers learned to compress furniture into flat boxes to conquer global retail. Today, their financial architects have compressed billions into an impenetrable structure to ensure they keep it.